I recently published a post explaining how the Deal Act could reshape some fundamental elements of the venture capital markets. Now, I know this can be some really dry material, so I wanted to create a very brief video of the highlights. Think of this as the abbreviated version. I promise. Stay with me for just a few short minutes, and I'll explain the gist of the bill and what it could mean for you. First, when I made this video, the bill had just passed into the Senate, but it hadn't yet passed into law. If it is, and I expect it to be in 2025, the president would then need to sign it for it to become law. Key point of this bill is to increase what is considered qualifying investments. Right now, VC funds have to limit non qualifying investments to just 20% of their overall fund. Once a VC fund has exceeded this amount of 20% by investing through secondary transactions or perhaps investing in other VC funds, it triggers enhanced SEC oversight, which is going to typically increase your compliance costs by about 8 times. So, as currently drafted, the new rules are going to classify secondary transactions and investments in other VC funds as qualifying. So what? So what if secondary transactions and investments in other VCs are considered qualifying? Well, all of a sudden, there's going to be a lot more buyers seeking secondary transactions, looking to either enter new positions into companies or increase their existing holdings. This new demand is likely to drive up deal volume, and I'd expect markets to expand or new markets to be created to begin to satisfy this increased demand. This is going to increase market liquidity, which should result in lower bid-ask spreads and increased trading. This means simply you're going to have more opportunities to sell your existing positions, either to exit completely or simply de-risk through limited selling. With VCs being free to invest more now through secondaries, you're going to be more likely to find buyers for your position. And this increase in demand should help drive down discounts or even increase premiums on some hot properties. A knock-on effect is going to be the launching of new funds and probably some new emerging managers in response to the investments in other VCs being qualified now. So basically, this is going to incentivize the seeding of emerging fund managers. In the end, I think if this is passed this year, it could provide some temporary relief to the pressure GPs are facing and with the reduced number of exits through IPO or acquisition. In fact, PitchBook already estimates that secondary transaction made up 30% of total VC exit value over the past 12 months. And this is ahead of IPOs, which only account for about 27% of exit value. And I'd expect this trend to continue if this bill passes. So, what do we do with this information? First, keep an eye out for news of the bill passing. This specific bill is now known as, or is now a portion of the broader bill expanding access to capital act of 2023. Now, I know, keeping track of all the various different bill titles, how they're related, and where they are in the process is not straightforward. Check out my comment for a link to the government website where you can keep an eye on this thing. And if this thing is passed and signed into law, seriously consider how it's going to impact your fund or program and how your fund or program could benefit. I haven't even touched on how some of these other bills are going to impact the VC industry. So hopefully maybe in the next post. I hope you think I kept my promise. I was only a few minutes, and I hope I explained the main gist of the Deal Act sufficiently. I'd love to get your thoughts and feedback, and please subscribe using either the link or the QR code. Appreciate your time, and drop me a line. I'd love to stay in touch. Thank you.